My name is Rich Wilson. I'm one of the co-chairs of the Philadelphia District Council of the ULI Young Leaders Group. We put on regularly scheduled events like this, educational events, both breakfasts and roundtables, typically monthly. And I just wanted to thank you all for coming and give a couple of announcements about ULI locally. We have another event here at Villanova, January 27th, that is on the state of the commercial real estate capital markets. So we hope that if there's any interest, you can attend that as well. And also for students, or anyone who has students, we are offering a scholarship and currently taking applications. There will be a $2,500 scholarship awarded to graduate students studying a major that is associated with the real estate industry. Could be design, engineering, business, real estate specifically, and a $1,000 scholarship to undergraduate students. Jerry or Jessica Taylor here with Villanova have applications, so if anyone's interested, please see them afterwards to pick up an application. And with that, one other thing, as always, I want to thank our sponsors that help us to put on these programs. KPMG, TD Bank, Commonwealth Land Title Insurance Company, and the Daniel M. DeLella Center for Real Estate here at Villanova. With that, I'm going to hand it over to Ed Liva with KPMG, who will introduce our speakers.
All right, thank you, Rich, and welcome everyone. Just a couple of logistical announcements. This is a CPE accredited event for those of you, the accountants in the room that need CPE, so make sure you sign up outside if you haven't already. And also within the materials, there's a survey that if you wouldn't mind at the end of the program filling that out and just leaving it on the table. Just to augment Rich's comments regarding ULI and the Dan DeLella Center for Real Estate, this is a big day for ULI. It's the 75th anniversary of the organization. For those of you who are familiar with the Urban Land Institute, it's viewed by many as the preeminent multidisciplinary real estate forum for knowledge sharing and networking. And here in Philadelphia, we have a very engaged chapter. And so if you're involved or interested in being involved in any way, Jerry Lipp in the back there would be the person that you'd want to talk to. And again, throughout the year, they have a number of forums like this. And the Dan DeLella Center for Real Estate is, Jessica, in our 6th year, roughly?
This is our 5th academic year.
Fifth year, and it's led by Jessica Taylor and Sean Houghton there in the back, and its overall mission is to develop and maintain a real estate course of study here at the Villanova School of Business. We've achieved the status of being able to offer a co-major in real estate now, and so we're moving forward at a very positive speed, so we're really excited about the program there. And in addition to developing that curriculum, our goal is really also to develop a network within the real estate community so that there are opportunities for our students in either internship programs or career opportunities for them. So please keep the Villanova students in mind. Our panel today and our topic is going to be on an accounting topic, which normally in a real estate forum you don't talk about FASBs in accounting, and even though it is my trade, it isn't something that we often spend a lot of time on, but this is a particular type of a provision that has a significant impact on landlords and tenants in a big way. So without getting into the details of the conversation, I'm going to introduce our panel. What we're going to do is cover some of the specifics of the new provisions. That's going to be led by Kimber Bascom. Kimber is a partner in KPMG's Department of Professional Practice. He's a main liaison between KPMG and the FASB board and the Emerging Issues Task Force. So he's on top of all these issues, and he leads our professional practice from a real estate standards point of view. Kimber will be talking about some of the history of where FASB has been with this new provision, and also some of the technical aspects of it. Following Kimber will be Lou Lease. Lou is a partner at Jackson Cross Partners. He heads up their industrial corporate practice. Most recently, he's been charged with leading their efforts in terms of helping tenants evaluate this new provision and help them wade through all the various aspects and how it will impact their financials, which we'll be talking about intensely. And then finally, we'll have Brad Malotsky, who will be talking about some of the impact that he's seeing from his perspective in terms of lease negotiations between Brandywine Realty Trust and their tenants, as well as what he's seeing out in the market. Brad is the Executive Vice President and General Counsel at Brandywine Realty Trust. We all are very familiar with Brandywine. Roughly $3 billion market cap and $25 million of property being leased. So they will have a good line of sight in terms of what is happening in the market. So I'm going to turn it over to Kimber, and so, similar to my household, the remote has gone missing here. So I'm going to be standing up here, and you guys just give me the cue when you want the slides moved forward.
Okay. Good morning, everyone. I guess we'll move then to the first slide on some of the technical issues around this topic, and you'll have to listen to this part to get to the good stuff later, I guess, on what some of this is going to mean from a business perspective. But some of the folks that I've talked to recently are wondering, is this thing ever going to become final? Is this actually final guidance yet? How long have we been at this for? Well, it all started back in 2006, not too long after the SEC issued a report that sort of blasted leasing accounting in general because of the fact that oftentimes leases are off balance sheet. So one of the main objectives that the FASB and the IASB had was to require lessees to put leases on the balance sheet in all cases. That's sort of the first and foremost objective that they've got. They also want to, believe it or not, try to make it a little bit simpler to account for leases. We can all debate whether they actually will have achieved that once they're done, but that was going in one of their objectives. And then they wanted to try to have the accounting standards under U.S. Financial reporting be basically the same as those that would apply around the rest of the world, and that's what they're trying to do with the lease project. At this point, we've had one exposure draft, which is an opportunity for people to comment about the proposed changes, and we expect for there to be another exposure draft coming sometime in the first half of 2012, so there'll be one more chance at least to debate and lobby for differences from what the two boards are proposing in terms of answers. We're still quite a ways out from probably having final requirements. That likely isn't going to happen until maybe 2016 at the earliest, based on where things are at this point. So just a few quick things in terms of what they're actually proposing. As I mentioned, no surprise here, they're proposing that lessees would put all leases on the balance sheet. And I'll talk a little bit more about what that would mean in terms of the numbers that would go on the balance sheet. Over on the lessor side of things, in the real estate world, happily for most real estate companies, the boards recently decided that if the leases of a so-called real estate investment property, so something that's just basically held for investing purposes and not for use in your own operations, that would still follow operating lease accounting, which is kind of what we do now for leasing purposes with real estate leases. But for lessors who are leasing other types of property, there would be a lot of changes. Basically, they would have no property on their books. That asset that's being leased would go away. It'd be replaced by a lease receivable and a residual asset. And I'll talk a little bit about how those would be accounted for. So quite a bit of changes over on the lessor side, and on the balance sheet from a P&L perspective, quite a bit of change for the lessees as well. Just in terms of what would go on the balance sheet for lessees, it would be the present value of the estimated lease payments. And the present value of the payments, the estimate would actually be made up of a number of things. First of all, starting with the lease term, you'd have to look and see if there are renewal periods in the lease or if there are cancellation provisions in the lease. And make a decision about whether there's a significant economic incentive to exercise those renewal options or not. And if there is, then those periods would be included in the time that the lease payments are estimated for. In addition, if there are payments that are based on an index or a rate, the amounts that would go into the estimated cash flows would be based on the spot rate at the commencement date of the lease. So that would be assumed to continue throughout the entire lease term when you make your estimates of the lease payments. If there are residual guarantees that a lessee provides to a lessor, there'd need to be an estimate of whether any payments would be due under those guarantees, and if so, those would go into an estimate of the payments. For leases that are cancelable, if there are termination penalties associated with those cancellation provisions, and the lessee concludes that notwithstanding the termination penalty, there is a significant economic incentive to terminate, then that penalty amount would be built into the estimated payments that the lessee would make. And then with purchase options, if there are purchase options in a lease, again, a lessee would look to see if there's a significant economic incentive to exercise that option, and if so, those payments would go into the estimated payments to be made. All of those would then be discounted back using the incremental borrowing rate of the lessee, or if they can figure it out, the rate that the lessor is charging the lessee in the lease. And if they can figure that rate out, they'd use that to discount the payments instead. So that would then be presented as a liability on the balance sheet. The asset that is presented on the balance sheet would be the liability plus any initial direct costs that the lessee pays to enter into the lease, minus any lease incentives. So if the lessee's moving costs, for example, are paid for by the lessor, those would reduce its asset that's reflected on the balance sheet. And then if they prepay any rent, that would be reflected as an asset as well. And after those amounts are put on the balance sheet, the liability would be basically a debt obligation, so it would have it would be amortized on an effective interest method where the interest expense would be reported in the P&L, and the balance would come down slowly in the early periods and faster in the later periods. The asset side would basically be like a PP&E asset or an intangible asset. It would be amortized generally on a straight line basis over the lease term. And the result of all of that is that the asset balance throughout the lease term will be lower than the liability balance will be if there aren't any prepayments. So in a general lease where the lessee pays their payments periodically, especially if the payments escalate, there will be a significant difference between the liability balance and the asset balance, where it looks like the overall transaction is underwater as a result of the pattern that the asset comes down by versus the liability comes down by. The timing of the P&L will be front-loaded under this proposal because of the interest effect on the liability together with the straight line amortization of the asset. So right now for operating leases we have this sort of a straight line expense pattern. That would no longer be the case under these proposals, and that's something that has lessees quite unhappy. It's also something that the boards are going to revisit before they issue their next round of documents to comment on.
There's plenty of room up front.
And we'll see if they, if they change that. But right now, it's a proposal that would accelerate the timing of expense on an individual lease basis. One of the unique things about this package of proposals is that after the original estimates are made, they would have to be updated on an ongoing basis. So every lease that a lessee enters into or a lessor enters into, they would have to continuously come back and look at those estimates of lease term, purchase options, variable lease payments, and so on, and update them as facts and circumstances change. For the lessee, most of those updates would only be a balance sheet impact, and then the change in the balance sheet would flow through in the future through the P&L. If there are payments that are, for example, a percentage of sales, those are going to go through the P&L as they happen for the lessee. And that's generally, in a nutshell, what lessees would be faced with under the set of proposals under this guidance. Over on the lessor side, basically for those leases that aren't of real estate investment properties, these are the leases where the lessor would have to book a receivable and a residual asset. That receivable would look a lot like the lessee's liability, and it would be estimated in the same fashion as the lessee's liability, except that any guarantees that the lessee provides on the residual interest in that asset would not be reflected in the receivable. They would just be considered in evaluating if the residual asset is impaired. And lessors are probably going to be impacted in their pricing as a result of that for leases other than real estate. A couple other things for lessors, with respect to the residual asset itself. Basically what a lessor would do under this receivable and residual approach is when they book the receivable, they will recognize a gain or a loss that will be calculated using the ratio of the present value of the lease payments to the fair value of the leased property multiplied by the carrying amount of the leased property. And that result will be the cost of the lease payments that they book at the beginning of the lease. It will produce a gain or loss, and the difference between that cost and the overall carrying amount of the leased property will be the residual asset that's recorded. The residual asset will be accreted using the lessor's discount rate, but the amount that's accreted won't be the same number that's on the balance sheet. And I don't want to get into a lot of those details for this crowd, but basically for non-real estate lessors, there are a number of complications associated with this particular proposal on the receivable and residual methodology. Lessors would also have the same requirement in terms of going through updates to their original estimates as lessees would. For lessors that are applying this receivable and residual approach, generally those changes in estimates would affect both the balance sheet and the P&L as they change the lease receivable, because every time they change the lease receivable, they will use that calculation that I described to come up with a cost of that change that is applied to the carrying amount of the residual asset. So there's going to be some amount of balance sheet and P&L impact generally for every time a lessor has a change in estimate, except if that relates to contingent rents such as a percentage of sales. And again, this would not apply for leases of real estate investment properties, which would be basically operating lease type of accounting. For anybody that has subleases, it'll be a little bit interesting because what will happen is the lease inside of the transaction will follow the lessee accounting rules, where you basically book a liability and an asset for the lease in. On the lessor side of the transaction, it'll either be operating lease accounting if it's an investment property, or it will be this receivable and residual approach if it's some other kind of property. And those two things won't match up. So there will be some noise, if you will, on the balance sheet for subleases. All of that will be presented gross. The lease inside will be presented on one side of the transaction. The lease outside will not be reduced. It will not reduce the lease inside. It will be presented separately. So some complications on subleases will result from that proposal. On sale leasebacks, hopefully I'm on the right slide. Yep. On sale leasebacks, many of you may be aware that for real estate sale leasebacks, it's very difficult for lessees to enter into a real estate sale leaseback that is off balance sheet today. That's because there are rules that basically treat those transactions as though they are a financing. And the FASB and the IASB had proposed to change that guidance and follow their proposals in their revenue recognition standard. They thought that by doing that frankly most sale leasebacks, including real estate sale leasebacks, would be sales followed by leasebacks for accounting purposes. As it turns out, they've recently been looking at their revenue proposals, and it looks as though the result of applying those proposals will mean that, in essence, all sale leasebacks would be financings. So that would be big news, obviously, for anybody that's doing sale-leaseback transactions. I think the two boards will come back and revisit that and decide whether they really want that to be the outcome or not. But right now, where we stand, it looks like that would be the outcome. If there were a sale, the leaseback would be adjusted so that it's at market terms if for some reason the provisions in the contract aren't at market terms, so that the gain or loss that's booked as a result of the sale leg of the transaction and the rents that are booked on the lease are at market terms if they weren't in the stated provisions of the contract. The other things that are probably of interest to folks as they get ready for these proposals are just how do we get from where we are today to where we're going to be. So the transition guidance, and essentially for any lessee that has an operating lease, they would have to go back in time and apply these proposals retrospectively, either under what we call full retrospective application, which means go back in time and apply these new rules as though they had always existed, or a modified retrospective approach, which is doing sort of the same thing but with some simplifications, some simplifying assumptions that allow the lessee to more easily get through the exercise, if you will, for operating leases. If the lessee has capital leases, they'd be able to choose to either grandfather those, keep doing the existing accounting, or apply these new rules fully retrospectively, going back in time as though they had always existed. Just as a quick example for the modified retrospective, the easier retrospective application for operating leases, the main simplification here is how do you come up with the asset that goes on the balance sheet at the original application date? And what would happen would be that the lessee would estimate the liability, and I've got an example here where you had an original lease term of 10 years, and 5 years are remaining at the date of initial application. So what the lessee would do in that situation is they would estimate the lease payments for the remaining 5-year term. In my example, I've got escalating lease payments. So they would discount those escalating lease payments back using the discount rate in the lease, which in this example is 10%. That would result in a discounted value in this example of $4,134. They would then calculate the annuity level payment that would be required to amortize that amount to zero over the remaining term of the lease. They would assume that that had been the constant payment throughout the lease term. So they would calculate what amount would have been on the balance sheet at day one. In this case, it would have been around $6,700 using that annuity level payment. And then they would calculate the amount of amortization that would have happened for the asset from day one to the date of initial application. So over that 5-year period of time, had we been amortizing the asset on a straight line basis, what amount would have been left? Around $3,350. So that's the sort of shortcut that they would get to do, as opposed to going back, taking the actual lease payments, going all the way back to day one and calculating exactly what amount would have been on the balance sheet. For lessors, the transition decisions would be similar. If there are operating leases, lessors would either have to do the fully retrospective application, or they could do a simplified type of retrospective application. In the case of the simplified version for lessors, those simplifications would basically involve looking at the fair value of the leased property for purposes of calculating the residual at the date of initial application, but otherwise there really aren't a lot of other simplifications. If the lessor has a sales type or direct finance lease, then those would be eligible for grandfathering, or they could use the fully retrospective application approach. So those are the, that in a very, very brief synopsis is the major points of the proposals, and I think we'll get into some of the implications at this point.
Maybe I could just pause, make sure there's no questions out there. I just wanted, maybe you could address a couple from my perspective. What are some of the factors a lessor will look at to determine whether or not they're included in this provision or they can continue accounting for it the way we're used to right now.
Yeah, so basically this idea of real estate investment property would involve looking at whether the property is held for current income or capital appreciation, so rentals and future gains or losses from the sale of the property, rather than the use of the property for administrative purposes in the lessor's business or operating purposes to provide services and so on. It raises questions around classes of assets like hotels, as an example. If a lessor is involved in operating hotels, those probably won't qualify as this sort of investment property type of notion. Other assets that probably won't qualify would be your senior assisted living type of property classes. Because those types of properties are viewed as being used in the operations of the lessor or of the owner, I should say, as opposed to being held primarily for investment purposes, just current income and capital appreciation. That's the way the standard setters have thought about it. Now, I think there are certainly those in the business community that don't necessarily think of them that way. And that will probably get a fair amount of debate, I would imagine, going forward.
Okay. So one other, go ahead, question?
Yeah, what are you going to do with like shopping centers and office buildings where you have various leases, terms, et cetera, et cetera?
Yeah. Right now, I think it's clear that if you had an office building that was purely held for lease to third parties, that would be in this, held for investment type of category. So those would all be operating leases. I think shopping centers would likely fall into the same category.
Apartments too?
I'm sorry?
Apartments?
Apartments probably as well. One of the classes of properties that has come up as a question mark is low-income housing arrangements, low-income housing tax credit-driven deals. And I think even those would probably fall into this, this exception, if you will. But there's some other ramifications. There's a possibility that the FASB will require fair value measurement for those properties. So this may not come without some other catches, if you will, such as a requirement to fair value measure those properties on an ongoing basis.
So Kim, a quick question. So you're a national guide, big firm. Other than the fine folks in this room who are clearly paying attention, who else is paying attention? And where are you getting inbound calls or emails from, and who are you guys talking to?
Well, we get a lot of questions from real estate property owners. They clearly are paying attention. On the lessee side, the retailers are paying a lot of attention to this package of proposals. Your big transportation companies are paying a lot of attention. Some of your banking industry is paying a lot of attention because those are areas where, I think Lou is going to talk more about this too, those are areas where there's just a huge impact from these proposals.
Somewhat related to Brad's question, this is an inside baseball look at FASB, but you said this exposure draft will be finalized maybe the end of 2012, and that there'll be debate and lobbying going on between now and then. What sort of debate and lobbying takes place with FASB? Who are some of the lobbyists? Who are they listening to as opposed to who are we listening to?
Yeah, they go out, their primary focus, the FASB and the IASB, is on investors. So their first, their top priority constituency is financial statement users. But in the process of going through these proposals, they also get feedback from companies that have to apply the proposals. And the companies that have to apply the proposals tend to lobby the hardest. And some of those companies are very large and very well connected politically. And as they go through their lobbying process, they tend to be able to move the needle on the outcome in many cases, even though they aren't financial statement users. I think on these questions, for example, like, will they change the pattern of P&L for the lessee, even though they have this financial liability on the balance sheet? It's interesting, financial statement users in general seem to be a lot more interested in the actual cash flows that are due under the lease than they are in the way that the income statement is affected by those, and they don't really seem to care a lot that the income statement reflects the time value of money or not. They seem to really just be more interested in what are the cash flows, what are the commitments that the lessee has. So there, on something like that, I think there's a chance that the companies that have to do it say, this is ridiculous, we shouldn't have to do it. We've always put these amounts through the income statement on a straight line basis, and the FASB and the IASB go out to investors, and investors say, we don't really care. So then that might change as a result.
So they're also then going to probably change their mind about the small operating leases, because the way it's written right now, any lease that's more than 1 year old or greater than a year has to be put on the balance sheet. That's ridiculous.
Yeah.
Especially talking about automobiles, copiers, postage machine, anything that has a lease. And they make the financial statements ridiculous to start off with.
Yeah, I think it's harder to predict what they decide on the balance sheet. There does seem to be a level of interest by investors in seeing the obligations show up on the balance sheet. So you're right that for leases of 12 months or less, you wouldn't have to do this. You'd be able to do operating lease accounting. I was listening earlier this morning to the meeting of the FASB and the IASB, and they were talking about this question, and most of the board members are still very uneasy about any kind of exception with respect to the balance sheet. So I think it's probably going to be an uphill battle to keep things off the balance sheet, but we'll see.
And I agree with that comment and your comment. But just step back for half a second. This all started in the context of kind of post-Enron. And what people started to get focused on was very large obligations that weren't showing up anywhere. So kind of like an aircraft lease of a big piece of equipment that was showing up nowhere because it was an annual expense. So that's where it started. Now we've taken Mr. Toad's wild ride a little bit here.
We've swung it so
Right,
far to the other
shocking,
end.
shocking.
Well, what's ironic, the chairman of the IASB, one of his favorite taglines was, he wanted to someday fly in an airplane that was on the balance sheet of the airline that he was flying with. This package of proposals is not going to put the airplane on the balance sheet of the airline, and it's not going to be on the balance sheet of the lessor either. It's just going to disappear. So it's kind of ironic that was the objective going in, and the result is going to be quite different.
What's this mean to major leaseback users like drugstores or Dollar General stores, those types of things? There's got to be big pushback.
Yeah,
It's Herculean. They have billions of dollars worth of real estate.
no doubt. I think, as I mentioned, it seems to have just become apparent to the two boards that maybe they've proposed something that would result in finance accounting for all sale leasebacks. I don't think that's what they had in mind. I think they will come back and look at that again. But the best case scenario probably at this point for those companies is that instead of having the whole asset on the books, they have some fraction of the asset on the books by virtue of having estimated the lease payments. So, they're not going to be in a situation like they are today where they get it off the balance sheet as a result of doing these transactions. There'll probably be something on the balance sheet.
Okay.
Can we back up kind of the more simple question to how the lease ends up as an underwater from a lessee standpoint?
Yeah, so basically, because of the way that the liability would get amortized, it'd be like a mortgage obligation. So the balance of that liability is going to come down slowly based on the interest effect and the time value of money. The asset side of the transaction, on the other hand, is going to come down. It's going to be reduced on a straight line basis over the lease term. So there will be, starting on day one, the asset balance will decline more rapidly than the liability balance will.
Why is the asset coming down quicker?
Just because it's being taken down on a straight line basis. So if I were to graph it, the liability will come down like this, the asset will come down like that.
Isn't that gonna have, like, the example, Jay mentioned the
Do we have
Walgreens-
I have that on the slide.
Technical
You know what, we're gonna. I
Hold that
think
thought,
Lou's
because I'll
slide-
show you
Hold it.
squarely.
He's got that.
Maybe
For
we
the
should
real
segue.
estate guys, there's pictures.
Pictures.
Alright, good.
Once you see it, you'll,
Why don't we just segue
One
into
final
Lou's?
question.
Okay.
The fair value measurement, who makes that measurement? Is that the accountants? Who put those all together as a cookbook? Is this an appraiser? Is this a
Lou.
third party?
It would be management, and, you know, it would be up to the company whether to use an appraiser or whether to use its own internal models, for example. But there are accounting rules, if you will, or guidance about, you know, what does fair value mean? And, you know, there's certain ideas that go into that appraisers would have to follow, or the company's management would have to follow if they do it themselves.
Okay, good segue for you, Lou.
All right,
pictures, man.
pictures, there we go. I might have to stand up for some of this, but first disclaimer is I am not a CPA, and I don't play one on television. I am here, I think, from a real estate perspective, to really focus on a couple of things and hopefully make this clear. A lot of my people who know me, who've seen us around this topic, have said, you know, what is an old industrial broker doing, you know, on accounting panels talking about lease accounting changes? And 3-4 years ago, when we started to look at this, there were really two objectives. One was, is this going to change the way we make money? And two, is there some money to be made in what's going on? And so we've built a practice at Jackson Cross around helping corporate clients start to get their arms around the information. And I at the end of this, the end of my comments, and before we start talking to Brad about how that's going to affect lease negotiations and tenants, I think I would tell you, regardless, unless it completely goes away, which Kimber and the people that he worked with don't believe it's going to go away, I would submit to you that it's already changed the way a lot of companies will do their leasing or evaluate leasing, primarily because in most big corporations, the thing that's incredible to see when you really get to it, the decision-making on real estate was rather lax. And I think we've all been the beneficiary or recipient of that over the years, where a local manager or someone could make a decision, where a regional president could make a decision. Now that the CFO's office, the CEO's office understands that this might impact income, earnings per share, balance sheet ratios, debt covenants, there's a whole new rigor around leasing, particularly real estate, because that's, in many cases, the biggest dollar percentage of leasing costs. So I think that understanding what we've developed and looked at and understanding this is important for anyone who's a real estate practitioner, because it is going to change the landscape. On 2 slides, and I'm going to stand up because this has a pointer, and I don't want to put my fat head in front of the thing. On 2 slides, I hope to show you, to answer the questions and show you this. What we modeled here was the net income effect of a couple of lease scenarios, a building where it was a 10-year lease with 2 5-year renewal options versus a 20-year lease versus a potential owned at 100% financing. And that's important because if you own a property and you get to depreciate it over 39.5 years, then it so drastically skews the curve on the low side of expense on income impact that in order to balance it, we assumed that for the purpose of this, if a company was evaluating it, they would say, let's say you didn't have to put any of your own cash in, so you don't have to worry about your hurdle rates or things like that, but let's put a cost of funds in based on their credit. So at the top, let's see if I have this correct, there you go. At the top, Kimber was talking about, the light went out. Oh, there it goes. No, it didn't. On the top right, Kimber was just explaining the blue line is today straight line accounting on a 10-year lease with 2 5-year renewals. So over the first 10 years, it's flat. If you renew, it kicks up for a 5-year straight line, and if you renew the second time, it kicks up again. Under the new accounting, you can see because of the way that they're amortizing the asset and that the expense line now, rent goes away. There is no rent expense. So EBITDA goes up, net income goes down in the early years of the lease because the amortization of the asset, which is straight line, plus the front-loaded interest from the liability, ranges that on a 10-year deal, and the numbers in the charts we run, it's somewhere between 7 and 12% increase in year one on your expenses. So that's why there is so much pushback from the lessees about what this is going to do, and we'll talk on a later slide about who gets impacted the most. Down on the lower left, we've laid out the purple line, which is if you amortize that same thing but assume that you were going to renew. And so that going in, they treated it as a 20-year obligation. You can see that it does a couple of things. It's probably 5% in the early years higher, and the spread between treating it as a 20-year and a 10-year in the early years gives you even worse net income impact. So companies are going to resist trying to do long-term deals. And if the straight line was in there on all of these, the one thing that's common is that it crosses the straight line at the midpoint of the lease. So this looks great whenever you consider a lease that begins and ends. We have two real-life examples. We have a retail client that has about 600 stores. They have been, in the last 15 years, they have closed 3% of their locations. So almost 97% of the time, they renew. And I think, Brad, when you're modeling, for people that do investment modeling, if you model office or industrial in Argus, you'll usually assume somewhere between 65 and 75% renewal. Brandywine has a
Brad
much
does
better
not model, the
retention.
smart guys over there model. Howard's the modeler.
Brandywine has a much better retention. They might have 80% of their tenants renew. The thing that changes this model and really messes it up permanently, we think it's a permanent increase in cost. We've modeled what they call a going concern, which is you never get to the bottom. The only way you get to the bottom of that curve is if you close. And if you replace the property and move, you still have the bump up, which is about a 30% year-over-year bump from the bottom of one curve to the top of the next renewal. The other thing that's not really clear on this, we had to pick a point and we did the renewal at the expiration. The reality is, as the rules are written, is when the business decides. That doesn't mean when you exercise an option. But when the business makes a decision that we're going to stay, you're supposed to restate. So again, you could be in the 7th year, you're only 3 years to the good side of the straight line, you make a decision that you're going to stay. At that point, you may not even have to notify your landlord. You might not have to exercise your option. But internally, if you have a rigor within your process that you've decided that that's an operation you're going to keep going, it's very profitable, you're supposed to go back and restate at that point.
So footnote, when and if you're a public company, the conversations internally about what you're doing relative to your lease space, to the extent they find their way into minutes and or they're discoverable, become an issue relative to how you and when you have to disclose, which is a kind of unnecessary or sort of ancillary impact to what Lou just said. So again, what that's going to generate is conversation without a lot of note-taking, and to the extent the notes are around and decisions are made, it could directly impact what the lessee in this instance has to report.
So the final comment on this, the green line is that 100% financed ownership. And there are really two schools of thought that I've learned over the last 4 or 5 years of this. There's the ostrich side, which is, this is never going to happen. We're wasting your time. Why are you bothering? This is a distraction. And investors aren't really going to care. They're going to adjust. It's not going to be a big deal. The other side is Chicken Little, the sky's falling. This is going to change everything. And I started out in 2006 or 7, the first time I heard about it, saying, this will never happen. And 4 years later, last year when they were coming up with the deadline or comments of December 2010, and they were talking about a release of the standard by June of this year, I was already at the other end. Chicken Little, this thing's going, we're touching everyone trying to do this. I've probably slid back somewhere not towards the middle yet, because I do believe what Kimber says, it's going to happen, but I think there will be continual adjustments to this, but it will definitely change. The income impact will change a little bit if they try to flatten it out, but the reporting impact, the compliance impact is going to be a material change no matter what they do, and majority of the large companies, public companies in the US and globally are not equipped or prepared to handle compliance yet, and let alone with the software that they're going to need to do it, which is not yet up to speed. On the balance sheet, and this is where I think the question came up, Kevin, about the impact. The top right is what we call a net equity curve, okay? And the red smile is the negative equity of a 20-year lease. So on this, what we modeled here, in year 11, which is the midpoint of a 20-year lease, or year 10, midpoint of a 20-year lease, an asset is about 20%, 25% of the overall lease value to the negative on the balance sheet. And if you just think about it, and think about companies that have 1,000 leases, or in the case of Walmart or Walgreens, 8,500 leases, the impact of managing these curves so that you don't get this cumulative effect of bankrupting yourself or having that negative, having literally a negative market value on your balance sheet is critical. And it's the opinion of the smart people in the room that the balance sheet piece of this is going to come no matter what. On the left side, the lower left, what we tried to illustrate there is the thing that public companies and CFOs hate the most, which is unpredictability. And if you look at our tenure, the thing with the quick jogs is if you had that tenure with 2 5-year renewals, okay, you get down to a 0 on the balance sheet, and as soon as you renew, your asset and liability on your balance sheet jumps up again. So one of the other things that we are working on with clients who are ahead of the game here is starting to look at smoothing your lease rollovers. One is looking at large-scale core assets that are on long-term leases and whether they should be owned. And the second is taking the rest of your portfolio and dealing with your rollover. Because if you can imagine it, if you had a 7-year average term, then every year you could take 1 or 2 years worth of those and make decisions on them. And if they kick the curve up, the other 60-70% have lost another year of depreciation so that you may be able to manage the net income and balance sheet impact. Okay? So there are two of the reasons. Are there any questions based on these? Go ahead.
From a banker's perspective, I mean, this is just like, I mean, this could completely change how we underwrite and value clients and their global real estate schedules. I mean, especially like you were saying with, you know, if they're running into the end of terms on their leases and then they're rolling over and, you know, things spike up, I mean, we have to start really evaluating how we're going to be looking.
I think that this is
Looking at
all, but this is all reporting.
Right,
I would submit to you that they're already in the same situation.
right.
So they're
That's a
paying the
separate
same
point, though.
rent, they're doing all the same things. This will affect, I think this will affect how banks or investors underwrite
Right.
based on ratios and things
Right.
like that. But frankly, if you're looking at Walgreens today, you should be looking at the fact that they've got $35 billion worth of leases off balance sheet. Somebody knows that that's an obligation.
That's the point. So it's a question of what the current banking system structure does relative to those multi-thousand store lessees. And how are you underwriting? What's going to be intriguing if, when this passes, is a lot of those clients are not going to be as smart as kind of the people Lou's talking to.
Right.
And they're going to be in the middle of a credit facility with limited ability to go back to you and say, hey, we got a bit of an issue here. Our ratios are totally screwed up now because I've now got good assets, but my liabilities are completely whacked. And so we want to redo our calculations. At which point the bankers may say, I don't know that we're going to do that. And so again, it's kind of recognition of what the issue is, because there's going to be not just one person, there's going to be a lot of people in that same kind of category.
I think the other factor for banks is just the regulators. And, you know, the regulators are watching this very closely, trying to decide what do we do for regulatory capital as, you know, some response to what we're going to see here. You know, as you look at your ratios and your underwriting, for example, how does that then translate to the regulatory capital requirements? And in theory, as Lou says, it shouldn't matter, right? Because the companies are in the same position as they were before the rules changed. But the reality tends to be a little different than that with the banking regulators. So we'll have to see what happens there, but that's a concern.
And again, it's all the words in the covenants.
Right. Right.
And so those words could create technical defaults,
Right.
which that's not where you guys want to be, that's not where the lessee wants to be.
Okay.
There's one back. Yeah.
Oh, go ahead.
I'm a finance professor, so forgive me, but on your picture with the easiest one up on the, not balance sheet impacts, I think, but on the income statement, if I'm teaching my students, I like that red line. In a low interest rate environment, as much as a valuation perspective, cash flows don't change. I get to take expenses earlier, which means my FCF, my free cash, is better in those early years, so that should have a positive valuation impact. Because the only real cash flow is your taxes, and you're gonna lower your taxes by increasing your expenses early. It's like an amortization.
I think in a public company where earnings per share and net
There's
income.
reasonable evidence when you have an earnings per share impact, it's not a cash flow impact, and actually the markets are smart enough to figure that out.
Right, it's GAAP.
Yeah.
Howard, speak up, you're right.
It's not, it's only for GAAP, it's not going to affect the tax accounting.
Right. So reported,
Yeah, I mean, all the tax accounting, for the moment at least, is staying unchanged. But the GAAP accounting, public disclosure.
so it doesn't have a cash flow effect at all, it just has, so that's obvious.
Again, for the
That's
moment,
getting-
the tax people may like something here, and who knows.
And I
Easy
think,
now.
don't think they like getting less taxes up front.
It's probably your point, if they see less revenue, forget about it.
Yeah.
The other thing, Sean, is this is more, and I think you're looking at it more from an owner investor of real estate.
No, I'm not even looking at but with the tax accounting is unaffected.
Right.
It totally changes.
I
It's a
think,
restatement of earnings, and that's gonna hurt.
I think analysts, in theory, you're right, they shouldn't mind, they should have already figured this out. But I think what we've heard is that in reality, there are additional details that will be apparent to the analyst community if these proposals go through that they weren't able to discern before. So before they might have had a 5-year table of projected lease payments, not a lot of information about the timing of those payments out beyond 5 years. This sort of information gives them a lot more insight into that than they previously had, and it could, in some cases, affect valuations, at least to some extent, as a result.
Any other questions? So I stole the Homeland Security rating system for this, for presentation purposes, but I think that if you start at the bottom, the lowest impact are going to be private, and this is from a lessee's perspective, not so much the lessor. I felt like Brad and Howard got a get out of jail free card on this with the recent change and all the real estate
Just be
owners.
careful, I go last, Lou.
But from a lessee standpoint, private companies with less than 50 locations, small business, lawyers, this is going to affect their statements. But the fact of the matter is, it's probably not going to be dramatic. It may affect some of their covenants. One of the things that somebody mentioned to me is if you actually do GAAP accounting and you're a law firm and your bonuses are based on EBITDA as opposed to net income, everybody got a raise.
It's better.
So you might see people redoing partnership agreements, but from a true accounting and value of the company standpoint, I don't think it's going to be that bad.
You still have the same problem. You still have the same issues. You still have the compliance issue.
Right.
That's going to exist. So whether you're a private company or a public company, and you're following GAAP, you got the same situation. And actually, for a smaller company, it may even be worse because it's going to cost them more money at the end of the day.
I think the compliance for less than 50 locations, while it will be a pain, because you don't have to do it today,
It's going to be a pain.
isn't near as material as it is to the.
It's going to be, I have to disagree with you from the standpoint that it will be material to the smaller company. It's all relative. You're comparing and saying, oh, well, you're a big public company, that's fine and dandy. The smaller company has the same issues and could have as equally as great an impact to their operation doing the, lease account.
It's okay.
So it all depends.
No,
Or you can take an exception and not follow the GAAP.
right.
And I would agree, because I think what's going to happen if this is adopted and you've got to do these disclosures, you're going to have to keep 2 sets of books for a variety of constituencies for a long period of time. You imagine if and when the U.S. changes to the metric system, you're gonna have at least 2 numbers on every sign.
Well, we have to get re-educated.
Exactly. So I think you're gonna have that same phenomena as this gets implemented. You're gonna have 2 sets of books. You're gonna have some group of investors, constituencies, partners, maybe yourself, who wants to see it the old way, and other groups who need to see it the new way. Then you're gonna be running interference between the two, translating all the time, all of the associated legal issues, documents you need to change, documents you haven't changed, partnership compensation agreements, et cetera. So I think while the intentions may have been sound at some point, the costs and burden of implementation, there's no way they've been anticipated.
I couldn't agree more. and
I would agree with that.
It's the compliance
We're
cost.
moving it to orange.
Huh?
We're moving it to orange.
We're going straight
Well,
up.
whatever's
We're
above
going
red.
right to the top.
What's above red?
It's more just severe.
But I think there's a couple of, oh, sorry about that. There's a couple of things that are key on here. In the garden, the decentralized real estate management, again, for practitioners of real estate, where companies have historically pushed out the decision-making, that's going to start to create some problems. And for people who are doing deals, even though the lessors don't have to do the accounting, for people who are doing deals, you have to expect 2 things. One, a longer deal cycle, which after the last 3 years, no one's looking forward to. And 2, the potential of retrades or restructuring the deal at the 11th hour once the CFO or the CFO's office has to sign off on it. As you move up the severity, at the top of the list are, as we described and Kimber described, airlines, transportation companies, multinationals. One of the interesting things, one of the companies, I mentioned Walgreens and their number of stores, but one of the other companies up there, GE, has probably 5,000 real estate leases. They have 1.7 million leases as lessor from their financing business. So from a compliance standpoint, they're concerned about real estate, but they're really concerned about the lessor rules and how they're going to comply with that. It's incredible. And we're spending most of our work in the red and orange area with companies just getting their arms around the leases, banks and different people finding the documents. And I started by saying, we were looking for ways that how is it going to affect our income, and are there ways to make money based on what the skill set that we have. And the preparation, analysis, compliance piece for the next 3 years is a pretty good business. And then transactionally, restructuring leases, optimizing terms, doing lease buybacks, we see as kind of the second wave of opportunity for people who are in the real estate end. Okay? These, I think, we were going to talk about with Brad, since he didn't bring a slide. I was going to share one of mine with him and let him opine. But again, down the long term and short term, one of the things that's come up in a lot of our conversations with CFOs, once you get past the ostrich and they say, okay, it's not coming until 2016. Fact of the matter is, if January 2016 is the transition date, public companies have to start accounting for the income statement, I think 2 years prior, and balance sheet 3 years prior. So that means they have to start at least paying attention by 2013. They could do it retroactively, I guess, in 2016, but they're going to have to go back and start getting their leases and getting into compliance. So they started to ask questions like, well, what can we do now? And from a deal perspective, we started talking about balancing their lease terms, rollover dates. So you may see people coming to you early for a shorter term renewal, or to try and set when the rollovers are. Trying to get purchase options, well, it's particularly on big properties in a lease. If ideally we're telling clients if 2016, 2017, you have a purchase option, it almost doesn't matter that you have to set a price if it's at fair market value, but if it's a big enough asset that should be owned or get ownership treatment, and you're going to be there a long enough time, it may be worth doing that. We've talked about convertible leases, carving out the TI. If the TI is part of the rent today, it gets escalated and it gets rolled into the asset. And if you're paying an interest return on that, and then you're imputing interest on the overall lease, you're kind of double paying on the TI. So we're starting to see more net leases with tenant improvements separated out as a financing, as a financing calculation. A trigger to change escalations, that was in there. Originally, there was a discussion about having to interpret CPI or estimate CPI, and for retailers, percentage rents, and fair market value assessments. And today, most of our clients like CPI increases because they don't have to straight line those increases. Under this, now you're going to have to estimate your CPI changes for future options, so there may be a change if somebody wants to go to a fixed increase or a fair market value increase. And then the last piece was eliminate percentage rent. Okay?
Are you finished?
It's all yours, Brad.
Excellent. So why don't you go to the next slide, Liv? Perfect. So a couple lessons learned.
Here, you can change it.
A couple lessons learned. One, you don't walk into the lion's den, which is, I'm sitting in, kind of the lap here of a bunch of very smart accounting people that have been thinking about this and ruminating on it and actually doing something about it, which I am not an accountant, and thankfully so. So folks in the room, kind of like Sean and Joe and Ed and Howard have been thinking about this stuff, and others, Bob, for a long time. Second, you don't let other people do slides for you. And so this is what happens when you let kind of other people kind of put together the presentation. So the two lessons are never talk to a bunch of accountants about accounting and never let other people do your slides. Second, or third, this is the part of the program where if you need to look at your BlackBerry, feel free to. I'm kind of used to that, so have at it. And if you're really bored, look in the back of the room, because this is what's been plaguing me all morning. What the heck are those bamboo things on the top of that? So if you guys can figure that out, then we will have really learned something today.
Pole vault.
I have a sense of what it is, so we'll take guesses afterwards. It's not a pole vault, though. Think back to like grade school. I think that's what it is. Anyway, the question I posed to Kimber earlier is the one that we've been thinking about a lot. So again, context, we're publicly traded and we're office folks. So does it have relevance to us, and kind of, if so, how so? And who's paying attention? And so you think about, where are we today? Pennsylvania, Villanova. We kind of sit between, no big surprise, New York, where people are kind of paying attention, and Washington, where people are kind of paying attention. But in between, as Carville once said, we're in kind of Alabama here. And why is that relevant to this conversation? It's relevant because kind of between the two cities, at least here on the East Coast, there are not a lot of headquarter operations, not big users of space, for the most part, in generalities. And so in that kind of Alabama between the two, most of the office leasing that gets done is 3 to 5 year term, maybe 6 to 7, and kind of call it 5 to 10,000 square feet, which is kind of the sweet spot of what we do. A lot of turn, but not a lot of big users. And so to this gentleman's point, well, isn't it still relevant for the smaller users? It may be more relevant, yes. Are they paying attention? So far, not really. So we have a different experience than Lou, who's been really a little bit at the forefront of this and running around talking to people about it. And it's a little bit of like Chicken Little, in that a lot of people are not paying attention to this issue. So smart folks are sort of saying, I don't think this is real. It's gone on since '06. It's not going to really get passed. When it gets passed or closer, I'll pay attention. It almost got close to the goal line, and then all of a sudden, the ball was like Lucy with, I guess Charlie Brown. The football got, pulled out again. And so, again, the smart people that are thinking about it then hear that and say, you know what, 2013, I got so much to do between now and then, I'll worry about this in a year from now, and they kind of put a tickler down. And so when we talk to our leasing agents, who are kind of in the market between called Central Jersey down through Richmond, every day they're talking to people. Office, again, so it's different in different contexts, so be careful what food group you're talking to. But in the office context, most of the tenants in that area, kind of East Coast, Princeton down through Richmond, most folks are not concerned about it or paying attention to it. Most brokers sort of know what we're talking about, but don't really. And so the brokers are kind of the first line of attack relative to what the tenants, the clients should be thinking about. And if they're not thinking about it, then they're not really talking to their clients about it. So again, unfair general characterization, but I'm giving you kind of the unvarnished view. There are folks that understand it, there are folks that are clearly talking about it. But for the most part in the office context, it's not real yet to them. In particular, it's become less real to us now, Brandywine, Howard, I, and others. Why? Because these guys said, originally we were very concerned relative to what's going to happen, because do we have to keep these two sets of books, and how's that going to work, and what are our investors going to be thinking about, and what are our joint venture partners going to be thinking about, and Howard's thinking, do I have to add 40 people to sort of deal with this? And all the accounting group guys are calling up and saying, oh, we can help you with this. And so when 2 months ago, they changed after 5 years and said, from a lessor's perspective, if you're leasing real estate, for the moment, you don't have to worry about it. Well, there's a whole group of people then that said, okay, I'm going to pay attention, but it's less burning now. So kind of put those people over here. So the whole group of smart folks that aren't now really paying attention. And so that lends to these conversations on, well, who really cares? The tenants are going to start to care. I happen to agree with Kimber and Lou. I think that when it comes down to it, this will pass. It's just in what form, to Howard's point, and when. So is it going to be a 13 thing, or are they going to kick the ball down the road again? Or they can, whatever phrase you want to use. And so the more the tenants are savvy to these issues, the more the bankers are kind of paying attention, which they are as well. When you start to redo credit facilities, people will add, and have started to, language in those credit facilities so that they're not left in a technical default situation. But to that point, are the small, think about a mall. I haven't been in a mall in 3 years, but I'm the bad example there. But if you walk through a mall, there's shoe stores all over the place. 1,000 square feet, 750 square feet. Well, they've got thousands of stores. They don't have the infrastructure to measure, monitor, track, think about when they're renewing. How are they going to report this if they're public or not public? How are they dealing with that issue? And the shoe store is just one example. So in retail, as Lou had indicated, a very real issue because it doesn't feel like it's going away on the retail lessee side. Now that will have a ripple effect on the landlord because at some point that retail tenant's going to figure out what they're going to want to do, and then they're going to go to the landlord and have to deal with it. And so long-term leases become slightly problematic in this example because the more you have, the more you got to book. So smart folks out there, not me, but commentators are saying, this will push people towards shorter-term leases. Feels right. So what happens? When they go to shorter-term leases, the tenant improvement dollars that me, an owner, want to give become smaller. It's just math. Why would I give them a lot more money when they're shrinking their term? So they're going to get less than they otherwise anticipate or have gotten for a long time. That's going to create an impact on, well, what's my store look like? Or what's my office look like? Or what's my mall look like? So there's, again, these kind of unintended consequences of, or intended, of what's going to play through the system. So the sense of it is shorter term. The sense of it is less TI dollars. The sense of it is when I negotiate for, as a tenant or a tenant's broker, the right to renew, do I really need that? Well, some would say, in an upward market, I want that. I want to lock in up front what my number is so I know, and I'm not subject to the whims of evil landlord, black hat, no hair. That's the issue. And so you sort of say, well, it's kind of a one-way street. It's, heads the tenant wins, tails I lose as the landlord. Why? Because if the market goes up, the tenant locks in with the lower rate. If the market goes down, the tenant says, I don't need the renewal option, I want to re-talk about my lease. So it doesn't help us as a landlord to give renewal options. But it's kind of a market thing. Everybody wants it, they feel good about it, they get it, the broker feels like a hero. It's all kind of what it is. In this context, though, negotiating for multiple renewal options puts you into that bucket of, okay, what's the probability that you're going to renew? Lou's example, they've never not renewed kind of thing. The accountants are then going to look at that and say, well, you got to value that. So is it you internally doing it? Do you have the resources to figure that out? Do you need us, an outside firm, to do that? So kind of cottage industry opportunity. So who's the valuation person that's going to go around and sort of help all these small companies that don't have that capability? So there's an opportunity there. On the title insurance guys, Allen and Allen, big owners of space that are big users of space are going to sit back and look at Lou's slides and say, and have been, if I'm going to have that lease effect, which is kind of choppy, and I don't like that, and I get this kind of depreciation deduction and I can own it, it's just math. Which one would I rather do? Can I borrow appropriately, cheaply enough to, buy and own as opposed to lease? So again, ramifications will happen relative to, I suspect, more so in the retail context and more so in the warehouse context, where big users of space are thinking about, well, I'm in hundreds of thousands of square feet across the United States. What should I do? What could I do? And what's the financial issue for me? So again, on the office side, at least on the East Coast, to wrap up, we're not really seeing that much yet. Some people are starting to chirp a little. No one has come in and said, I must have this. No one has said, I don't want a renewal option. It hasn't gotten to that level. And so I think that the office folk, who the guys and gals who I talk to, no one's really seen this yet. They're hearing about it, they know about the issue, but their tenants are not pushing it yet. I do think in the retail and in the warehouse sector, you're going to see some pretty big moves the closer we get to 2013. So, with my blank slide up there, and with the thanks of Lou for putting together the slide presentation, I'm going to stop short because, again, I could have talked for a long time 2 months ago, a month ago, about what we were concerned about. That's been kind of eliminated relative to we are owners and lessors of real estate, but this impact is going to be less on us now because of the change in direction a month and a half ago. So again, if you're an owner, it's good news, and you know, Merry Christmas, Happy Hanukkah. Kind of thing. Questions?
When you look at, the pending rules are going to be ready 2012. It might get passed 2016. And then, and I'm sure there's been some lobbying from some big companies to say this is really going to affect us negatively. Just in alliance costs, from perhaps a company like yours has to think about something like that. Then you look at Lou's slide here that says severe and high. You look at the entities on that slide. Public companies, all the retailers, healthcare, GE, this is a huge, and if all these guys said, you know what, this is going to be a really negative impact, let's go crazy and unleash this army of lobbyists and affect the government, and whoever we have to affect. So I'm curious, all four of you, what are the odds this really gets passed?
It's a great question, so I'll take a first shot and then you guys can sort of think that through. In the office context, I've heard of one deal in the entire kind of United States in the last 4 years where this was noted as the reason that a big user in the office context bought. So Lockheed bought a building down in Washington, outside of DC, where they said, the reason we're doing this is because we're concerned about the accounting rules and we may as well own, because we're going to be in this building for a long time. So again, the office context, I think that there's not going to be, or there most likely will not be that groundswell of, my God, the sky's falling. We can't take this. Because for the most part, we're not going to really be impacted. But, that being said, NAREIT, which is our national association, very much involved in this conversation. The Real Estate Roundtable, on behalf of their members, very involved in this conversation, and lobbying for modifications of, kind of smoothing the edges of this, because their belief was, the train was on the track, it left the station, it's just a question of how much you can sort of modify the end result. And so their view, much more enlightened than mine, was that it was going to happen, and you had all the right forces lining up, right or wrong, I guess, depending, nationally and internationally, to sort of combine overseas accounting with our accounting, and therefore what the standards would be. But again, these guys are much closer to the FASB and the International Standards Board to know that. Our two trade associations, though, very focused on it. But the weird thing is, it's hard for a Target, a Walmart, a GE to sort of coalesce together and say, hey, this is screwed up, let's go together. And they'll do it on their own. And they're effective because they're big companies, but they're less effective than if they're together, everybody walking in and saying, hey, this is ridiculous. So the hey, this is ridiculous hasn't really happened other than through ICSC and the Real Estate Roundtable and kind of those sorts of trade organizations. So they're being heard, but the people that are writing the standards, do they really care about what they have to say? You guys are different views.
Kimber's probably the closest.
I guess a couple of thoughts. One is the Equipment Leasing and Finance Association did a study to try to ascertain the impacts of all of this, and they estimated that there would be over $1 trillion coming onto the balance sheet across the business community in the U.S., and that more than 70% of that would be for leases of real estate. The rest would be basically equipment leases. And they also, as part of their study, estimated job losses that would occur as a result of these proposals. And the job losses were not insignificant, certainly. I think the issue that you run into is a bit of a tug of war between the job creators and the investors. Some of you may recall that there were a number of years ago, over probably 10 years ago or so now, there was a debate about whether stock comp should be reported as an expense by companies in the income statement. And there was a bloodbath, literally, from a lobbying perspective over that issue. Companies went to Congress, said this is going to kill jobs, this is going to kill small businesses, innovation's going to stop. Arthur Levitt was the chairman of the SEC at the time. He relented on the issue, and it ultimately got put on the back burner. In the aftermath of all of that, there was a reconsideration, and ultimately it went through. And there was a fairly strong consensus that investors were damaged as a result of the delay and so on and so forth. So I think there is a pressure point on job loss, job creation on the one hand, but there's also the counter perspective of everybody's an investor these days, and to the extent that investors are getting harmed, that's going to come through as well. For that reason, I think that there could be delays, but at the end of the day, I don't expect this to get killed off in lobbying efforts. I just don't see it happening. There could be tweaks to it in terms of what happens in the P&L, but I really think these things are going to come on the balance sheet from a lessee perspective one way or the other. It's just a matter of time. And one of the reasons why we're talking about an effective date that's so far out in the future is that for public companies, they have a 5-year table that they have to provide in their financial statements. That 5-year table would have to reflect all of these new rules in the first year that they apply them. So if they apply it for the first time in 2016, they've literally got to have the data baked into their numbers starting at 1/1/2012 in order to comply with their 5-year table requirements. And that's one of the reasons why that effective date is so far out into the future. But I don't see this going away. I do see a huge debate about it, but I just don't see it going away.
It's also, some people think, is it a D and an R thing? So if the Republicans sort of go into power, is that going to have an impact? And the punchline is, it will have an impact. It could kind of delay it, as Kimber was just saying. But the FASB is theoretically removed from that. Now, theoretically is the real word. So it would have an impact, but again, from what I'm reading from our trade associations, they are of the mind that it's going to happen. It's just a question of how long.
I think that the other factor is that this is international. This is a joint workforce from FASB and the IFSB. It's part of the convergence of global accounting standard. And as the U.S. companies, which are traded on the stock exchange here, become more and more globalized, I will tell you, we just finished 2 projects trying to abstract international leases for 2 fairly big companies. The record keeping, the leases, the accounting is very lax outside the United States, as you can imagine. And some of these companies that are up there are in 150, 200 different countries. And as they become, as a greater part of their business becomes outside the United States, I think the SEC starts to say, without these type of things, you have no idea what's going on. There's no real way to track what obligations they are creating internationally, and it's ultimately for the protection of the investors. So I think that international flavor to this, probably as much as anything else, is going to mean that it will happen eventually.
Just one last point. I think we're in an environment now, as Lou was saying, where the investors' concerns trumps any noise that you might hear from groundswell in terms of the uncomfort or the discomfort with applying these. And more importantly, as Brad alluded to, the FASB is a little bit of an independent source, as is the IASB, the International Board. So the typical lobbying paths that we would normally pursue when something was in front of Congress is different from what's at stake here. These lobbyists are of a different breed, and the FASB is not an elected board like Congress is. I think we're probably at the end of the session.
So the heat came back on. You guys were cold and awake, and then the heat came back on. Everybody fell asleep.
I thought that was all the hot air.
I heard there will be a prize for anyone that guesses what the bamboo poles are in the back. I'll see Jessica on that.
I'm lobbying that they're canockling sticks for that dancing thing. Canockle. I can't spell it, but I think it's canockle.
Okay.
tiki bar here?
Yeah. Okay, no, the
Limbo.
toga parties, okay.
Limbo.
So thank you all for attending. Please join me in thanking the panelists. Thank you to ULI and Stilella Center for Real Estate, and best wishes for a happy holiday.